How is everyone doing today? Welcome back to another episode of the Banker Next Door. I'm your host, Dr. Joe Berquist. Today, I wanted to talk to everybody about bank examinations, particularly for community banks. Are they about to get better? I saw this recent article in Bank Director that I wanted to bring up to everyone's attention here. So, this was titled Community Bank Exams Are About to Change. Regulators are slimming down exam requirements for small banks, driving optimism among lawyers that reams of paperwork will get smaller. So this just came out October 31st. So basically, it says here community banks got big regulatory victories under the first Trump administration, but reining in the juggernaut of behind the scenes bank supervision was harder. That's quickly shifting as Trump's new pool of bank regulators settles in. A blitz of announcements has industry lawyers optimistic, hoping that the excessive paperwork bankers have long complained about gets lightened. It is a significant management burden. It's a significant financial burden, says Jacques Krupa, a partner at the law firm Bradley Arendt Bolt Cummings. It's a common reason we hear for banks that want to sell. They're just tired of the regulatory burden. Um, it may take time for those actions to trickle down to bank supervisors, Krupa says. But banks should monitor the changes from Washington, she says. There's plenty to keep track of. Regulators are proposing to use matters requiring attention, MRA, which can be a precursor to tougher actions only in cases where there are material financial risks. Concerns such as succession planning or flawed internal procedures are less likely to meet that threshold, said the OCC and the FDIC. Effective January 1st, 2026, the OCC is scrapping exam requirements for community banks that aren't found in law or regulation. Agencies are promising a renewed focus on tailoring so that smaller banks aren't subject to the same standards as bigger ones. The FDIC, which oversees most community banks, is also releasing banks from the regulatory penalty box sooner. Banks can now be freed from FDIC cease and desist orders if they're in substantial compliance with regulators' required fixes rather than full compliance. Critics argue the series of changes will hamstring supervisors, making it harder for them to flag risks at banks before they become more severe. Bankers may be happy they'll get dinged less, but examiners' whole role is to help identify these flaws so a bank can improve, says Todd Phillips, a former FDIC lawyer who now teaches at Georgia State University. My advice to bank directors is don't look at your examiners as the enemy or the opposition, Phillips says. These people who could serve as another set of eyes looking at the bank to help you make sure that you are in as strong as position as possible. One recent paper found supervisors anticipate most bank failures with a high degree of accuracy. sorry, sorry, I had to laugh at that one. For forcing earlier corrective actions and thus lowering the blow to the financial system. uh, um, when has this happened? When have the regulators miraculously swooped in to prevent the bank failure? I must have missed this. I must have missed this one. Yeah, no, they usually come in and sweep up the wreckage and then downplay how they missed this or missed that on the back end of it. Usually wait about 2 years to come out with a lot of their reports on why a bank failed, just in case they might have had something to do with it as far as like neglecting or not watching what's going on. Silicon Valley Bank, so we'll leave that as it were. Tone at the top. So more supervisory announcements for community banks are in the works. The OCC's steps were a down payment on more things to come, Controller of the Currency Jonathan Gould said at a recent conference. Regulators aren't looking to weaken our supervision, Gould said, but instead are focusing on what matters. You, just like we, have limited time and attention, Gould said. I'd much rather have boards of directors and senior management at banks focused on the median and long-term competitive threats, their strategies, serving their consumers, than dealing with the 16th MRA around a change management issue. Yes, I agree with that completely. It's a similar message from top leaders at the FDIC and the Federal Reserve, the two other major federal bank regulators. It is one reflection in a recent speech from Treasury Secretary Scott Bessent, who said post 2008 reforms gradually suffocated community banks and left a trail of destruction in its wake. No longer will regulations serve to entrench big banks and empower Washington bureaucrats to the detriment of community banks and the clients they serve, Bessent said. The industry has clearly noticed, with one survey from the Conference of State Bank Supervisors finding that regulation fell from the banker's top perceived external risk last year to sixth in 2025. I did cover that report in another episode. If anybody wants to go see it, I tell you what, I will actually put a link to that episode at the end of this if you want to go check out that report, because there was some really good, interesting stuff in there. The tone at the top matters, says Brian Graham, a partner at the consultancy Claris Group, and could translate into smoother relationships between banks and supervisors. That is more likely to have a bigger material impact on the day-to-day lives of community bankers than changes to supervisory manuals, he said. So then we get into lightening the load. That doesn't make the supervisory changes any less meaningful, Graham and other observers say. The OCC, for example, is telling its supervisors to adjust their exams for community banks depending on their size and complexity. It is also defining community banks as those with under 30 billion in assets, up from the traditional 10 billion threshold. Automatic requirements that the OCC set over the years and aren't required by law or regulation will be scrapped for community banks. That includes a risk assessment for fair lending practices, as well as periodic reviews of compliance with the National Flood Insurance Program. Examiners can dial up requirements if they deem it necessary, but they will not do so for the sake of completing procedures required by OCC policy, the agency said. The OCC is also requesting less data from community banks. Those are welcome changes from bankers who frequently say that the top pre-exam document request process is unnecessarily burdensome, says Patrick Hanchy, a lawyer at Alstone and Bird. Bank personnel are spending a lot of time providing stuff that's really not related to whether the bank is operating in a safe and sound manner. It's just really a lot of paper pushing, Hanchy says. I've heard that a lot through the years. Yeah, I would absolutely 100%. The OCC is also loosening supervision around risks from models that community banks use, whether for underwriting loans on their own or made through fintechs. It will limit a massive ongoing expense for banks that spend on personnel to validate what can ultimately be simple models, says Matt Bizans, a lawyer at Mayer Brown. Rather than requiring full annual validations, the OCC says examiners should decide whether an individual bank's usage of models warrants more scrutiny. So focus on material risks. Lawyers are also optimistic that the agencies will no longer escalate minor process issues into punishing banks for unsafe practices. The focus on material financial risks to bank is at the heart of regulators' directives to supervisors. But the OCC and the FDIC are also proposing to formalize that approach in a new rule defining unsafe and unsound practices. The proposal is open for public comment. Bizans of Mayer Brown recalls clients who've gotten dinged for problems with Reg W, which cover bank transactions with affiliates, even if they were a tiny portion of a bank's balance sheet. Was the examiner correct that they identified transactions that appear to violate Reg W? Sure, he says. Is there any way that that transaction could have led to the failure of the bank? No. Full stop, no. And then we get to early release. For banks who do get in trouble, the FDIC's new standard releasing them from consent orders once they're in substantial compliance could help them expand sooner. It takes a long time to get back in good graces with regulators, says Chip McDonald, a bank lawyer at McDonald Partners. And in the meantime, getting regulatory approval for new branches, new products, or mergers gets tougher. The standard has recently been almost perfection, says Krupa, the Bradley lawyer. And if banks have effectively met the mark, they can get back to their fundamental blocking and tackling quicker, she says. That's positive for the banks, she says. It's positive for the communities they serve, and it's positive for our economy as a whole. And yes, I would say that this is really great welcome news, because I think that, again, after 07, 08, you just saw the amount of regulation on banks. And I've talked about this before in other episodes, other live streams, things like that. When you think about, I think about pre 2008, when a lot of banks, if you were a $1 billion bank, your security, risk management, compliance department, I mean, that might have consisted of maybe, two people. And those people might have been getting paid, 40, $50,000 a year salaries. I mean, their job was pretty basic. Not really anything too crazy. After '08, I mean, my gosh, that the whole industry changed. All of a sudden, you needed a compliance department with, 7, 8 people. Everybody's getting paid, 80, 90, 100 plus $1,000 a year. That is a huge cost and an enormous expense on the bank for people that basically aren't doing anything. They generate zero revenue for the bank. It's just a cost. It's just a cost to the bank. Now, again, a lot of people out there would say, well, yeah, but you need that regulation and you need all that to, make sure the bank is safe and sound. Do you really? Do you really? And I think that's what this article is really calling into question here is that, hey, a lot of this stuff has really been overburdensome, highly expensive. We've put a lot of smaller banks, basically, perhaps unnecessarily, in this box where they're getting treated like a bank, like a bank that's 250 billion in assets, a large regional bank. And that just and again, a lot of these banks, particularly, again, they're looking at increasing the threshold from 10 billion to 30 billion, which again I think would be fantastic. But you look at your typical bank that's 2, 3, 4, $5 billion in asset size. I mean, there's not really a whole lot to them. I mean, they bring in deposits, they lend money out. Maybe some of their lending strategies vary a little bit. Like maybe this bank just wants to be a residential mortgage shop and do a little bit of commercial lending. Maybe this bank is bigger on commercial lending, just wants to do a little bit of residential lending. So the flavor of the type of lending can be a little different. Maybe this bank has a niche over here. Maybe this bank likes to do a lot of multifamily loans, and this bank likes to focus more on industrial properties. So you can get these little nuances in terms of the type of lending, but it's all the same stuff, though. It's all commercial lending, residential mortgage lending, bring the deposits in the door, build relationships with customers, cross-sell the customers on treasury products and stuff like that. That's really all there is to it. And then you're just basically looking at the investment portfolio of the bank. How are you guys investing your money in terms of treasuries and bonds? What does that look like? How could that potentially affect you? How are you managing interest rate risk? All this kind of stuff that you get into when you're looking at a bank and considering how it runs and how it functions and what they need to do to maintain safe and sound practice. And then also, a lot of people don't understand banks get what's called a camel rating by the regulators, and that all had the camel. And I'll do episodes on the camel ratings and what that all means. But the camel rating is what you get from the regulator, and that's the big thing. That's the big thing between the bank and the regulators, which basically tells, is the bank doing a good job? Is the management doing a good job? Is the bank well capitalized? Does it have good liquidity? Is the credit portfolio performing properly? Or is the safety and soundness of the bank overall in a good spot? That's the real deal. Like I said, a lot of this other stuff on the periphery, again, the stuff that the OCC, oh, well, you got to provide us this, you got to do that, but it's not really in the part of a regulation. It's just kind of a policy and procedure of the OCC. Like, well, okay, just because they want it or they like to look at it or whatever. I mean, so all I'm saying is sometimes that stuff is not really warranted and it's not really helpful. So again, I think this is really interesting. I think this is really good news for community banks. This could help a lot of community banks out there continue to grow and prosper into the future. And this is a good thing because, again, we want, again, I think as an industry, we need to get more banks out there. We need to see more growth. We need to see more de novo banks. We need to see just more, growth come up there. I think we're getting to a point where I think we're getting close to having too few banks in the country. We're having there's too much concentration amongst the big 4 or 5 banks at the top. I think, that is that's a concern. That's a concern. So, okay. I'll leave it at that. I'll leave this episode at that. So, with that being said, if you like this episode, please make sure to like, share, and subscribe. That really helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I always love getting back to everybody. And as always, make sure to check out some of the other content on the channel. I hope everyone has a great day out there. Thank you for listening, and I will see you again real soon.